I was driving the other day and my car started making this terrifying sound.
Oh,
Yeah,
no.
like a rhythmic clunk clunk hiss coming from somewhere deep in the engine block. And do you know what my immediate reaction was?
I assume you pulled over and started panicking.
Well, yes, panic was definitely step one, but step two was I drove straight to the mechanic. I didn't pop the hood, grab a wrench and say, I bet I can recalibrate the fuel injection system based on a YouTube video I watched once.
Right.
I have zero shame in admitting that I am completely incompetent when it comes to internal combustion engines. I outsource that problem immediately.
Which is the rational thing to do. I mean, if you break your arm, you go to a doctor. If you get sued, you hire a lawyer.
Yeah.
We outsource the high-stakes, complex problems in our lives to professionals all the time.
Exactly. We love experts. But
Yeah.
then we get to money,
Yeah.
we get to investing, and suddenly the logic just, it flips.
Yeah.
I feel this immense social pressure to be the expert, to
Mm.
pick the winning stock, to time the market perfectly, to somehow know more than the entire global financial system. Why is that? Why is investing the one area where doing it yourself is seen as this, badge of honor, even if most of us have absolutely no idea what you're doing?
It really is a fascinating psychological phenomenon. I think part of it is the gamification of the markets, the flashing lights, the apps on our phones. It makes it feel accessible, like a video game.
Yeah, it feels easy.
But the reality is, for the vast majority of people, treating your life savings like a DIY weekend project is incredibly risky. You aren't just betting on a horse, you are navigating a complex global ecosystem. And that fundamentally is why the mutual fund industry exists. It is the institutionalization of professional help.
And that is exactly what we are unpacking today. This is our deep dive into decoding the basket. And I want to be clear right off the top. We aren't just going to read dictionary definitions of what a mutual fund is. That would be boring, and honestly, you can Google that.
Right. We want to go much deeper.
We are going to tear the concept apart. We're going to look at how the sausage is made, who picks the stocks, why they pick them, the weirdly specific flavors of funds you can buy, and the actual math behind constructing a portfolio that lets you sleep at night.
Mm-hmm.
We're talking about everything from the guy sitting in a high-rise deciding to buy German steel to the mathematical curve that defines efficiency.
We are pulling from some very detailed educational texts today, specifically focusing on mutual fund structures and portfolio management theory. We've got the technical specs on everything from liquidity mechanics to the efficient frontier.
I have to admit, I am personally very excited to finally settle the debate in my head between global equity and international equity, because apparently they are not the same thing. I've been using them interchangeably for years.
They definitely are not the same thing, and confusing them can actually leave a pretty big hole in your portfolio, but we will get to that.
Okay, let's start at the very beginning. The vessel itself. When we say mutual fund, most people just think retirement account. But mechanically, what is happening?
At its core, a mutual fund is a pool. Imagine a massive swimming pool.
Right.
Instead of water, it's filled with money. This money comes from thousands, sometimes millions of different investors. All that capital is aggregated into one large pot.
So my $500 is mingling with your $5,000.
Exactly. And that massive pot is entrusted to a professional manager or a team of managers. Their job is to take that pool of cash and invest it in a variety of securities like stocks, bonds, or other assets, depending on the fund's specific mandate.
So the alternative would be me trying to buy one share of Amazon, one share of Apple, maybe a government bond. But here, I put my cash in the pot, and I own a slice of the whole pie.
Correct. You own units of the fund. If the fund owns 100 different companies, your one unit represents a tiny fraction of ownership in all 100 of those companies.
Okay.
But here's why we need to make a technical distinction that a lot of people miss. There are actually two main structures for these pools: closed-end funds and open-end funds.
Okay, let's unpack this. Closed end. That sounds exclusive, like a club you can't get into.
It's actually the OG mutual fund structure, the original. Think of a closed-end fund almost like a company going public. They have an initial public offering, or IPO.
Right.
They issue a fixed number of units, let's say 10 million units. They sell those units to investors, they take the cash, and they invest it. But once those 10 million units are sold, that's it. The door closes.
So if I hear about this amazing fund a week after the IPO and I want in, I can't just call the manager and say, here's my money, give me some units.
No, the manager isn't creating any new units. The pool is fixed. If you want in, you have to go to the secondary market, like the Toronto Stock Exchange, and buy those units from another investor who wants to sell.
Okay, so it trades just like a stock. I'm buying it from Bob, not from the fund company.
Exactly. And this leads to a really interesting quirk regarding the price. Because there is a fixed supply of units, the price is driven entirely by supply and demand on the stock market.
Which means the price I pay might not match the value of the stuff inside the fund.
Precisely. Every fund has a net asset value per unit, NAVP. That's the actual value of all the stocks and bonds inside the fund divided by the number of units. Let's say the NAVPU is $10.
Okay.
If everyone is desperate to get into this fund, the price on the stock exchange might be bid up to $12.
So I'd be paying a premium. I'm paying $12 for $10 worth of assets.
Right. Or if everyone is panic selling, that $10 unit might be trading for $8.
That seems wild. You could buy a dollar for 80 cents.
That's the arbitrage opportunity with closed-end funds. They can trade at a significant discount. But most of what regular folks see in their 401ks or RRSPs isn't this structure.
Right, because usually when I send money to my investment account, it gets invested. I don't have to bid on it.
Exactly. Today, we are mostly focusing on open-end mutual funds. This is the standard model. Open-end means there is no limit on the number of units. The pool is elastic.
So how does that work mechanically? If I send the fund manager $1,000, what do?
They literally create new units out of thin air just for you. They take your $1,000, add it to the pool, and issue you the corresponding number of units. The pool gets bigger.
And if I want to cash out?
You sell your units back to the fund, they destroy your units and pay you the cash from the pool gets smaller.
So because the fund is always willing to create or destroy units, the price must work differently than the closed-end ones.
Yes. Because of this mechanism, the price of an open-end fund always reflects the net asset value per unit. There is no premium or discount. If the assets inside are worth $10 a unit, you pay $10. It's calculated once a day, usually at 4:00 p.m. when the markets close.
That feels a lot fairer, or at least more transparent. Yeah. I don't have to worry that I'm overpaying for the basket itself.
Yeah.
So we know the structure, but why do we do this? Why pay someone to manage this pot? Why not just buy the stocks myself? We mentioned the mechanic analogy, but what are the specific benefits outlined in the source material?
The texts highlight 4 key pillars. The first is liquidity.
Which is finance speak for how fast can I get my cash?
Exactly. If you invest your money in a weird piece of commercial real estate or a private family business or even a rare painting, that is an illiquid asset.
Right.
If you need money for an emergency tomorrow, you're out of luck. It might take months to find a buyer.
Right. You can't sell a bathroom tile from your investment property to buy groceries.
But with the mutual fund, because of that redemption feature we just discussed, you submit a request and you usually have your cash in 2 to 3 business days. The fund manager keeps a little bit of the pool in cash just for this reason so they can pay people out instantly.
Which is huge for peace of mind.
Okay.
Pillar 2.
Diversification. And this is the big one mathematically. This is the free lunch of investing.
I love free lunch. Break it down.
Imagine you have $1,000 to invest. If you try to build a portfolio yourself, how many companies can you buy? Maybe 2 or 3.
If Amazon is trading at what, $150, I can buy a handful.
Right. Now imagine one of those companies has a massive scandal. The CEO goes to jail. The stock drops 50%. You just lost a huge chunk of your total wealth. That is concentration risk.
It's the eggs in one basket problem.
Exactly. A mutual fund pools millions of dollars. It can hold hundreds of securities. It might own 500 different companies.
Wow.
If one company in the fund goes bust, it's a decimal point error in your portfolio. It might drop the fund's value by, 0.1%. You barely feel it.
And for me to try and buy 500 different stocks with my $1,000, the trading fees alone would bankrupt me.
Which leads perfectly to the third benefit, low cost and convenience. Because the fund has subtle economies of scale, the costs of research, administration, and trading are shared across thousands of people. It makes professional management affordable.
And speaking of professional management, that's the 4th pillar. We are hiring a brain.
Yes. You aren't just getting a basket of stocks, you are hiring a portfolio manager. These are people who typically hold designations like the CFA Chartered Financial Analyst. This isn't a hobby for them.
Right.
They have access to sophisticated analytical tools, entire research departments, and often they have direct access to company management teams.
So they can call up the CEO of a company and grill them on their quarterly earnings.
Often, yes. Or at least attend private briefings that you and I aren't invited to. They follow a rigorous, disciplined process to select securities. So you're essentially paying for their expertise, their tools, and their access.
Okay, so we have the vessel, we know why we use it, but now we need to talk about what goes in the vessel, because not all mutual funds are created equal. I want to walk through the safety net first, the stuff for people who are terrified of losing money.
We are looking at the bottom left of the risk-return graph here. Low risk, low return, the foundation of a conservative portfolio.
Let's start with the parking spot for cash. Money market funds. I feel like people ignore these, but when interest rates are high, they suddenly become very popular.
Money market funds are designed for one thing: safety of principal. The goal isn't to get rich, it's to ensure that $1,000 stays $1,000 while earning a little bit of interest.
And what are they actually buying? It's not stocks.
No, absolutely not. They invest in very short-term debt. We're talking treasury bills, T-bills, commercial paper, bankers' acceptances. Crucially, the regulations usually state that the average term to maturity for the whole portfolio has to be 90 days or less.
So these are loans that are going to be paid back in a few months.
Yeah.
Very low chance of default.
Extremely low. And because the assets are so short-term and safe, these funds are managed to keep a constant unit price, typically fixed at $10 or $1, depending on the currency.
Okay.
If the fund earns interest, they just give you more units or pay it out as a distribution. It's designed to feel like a high-interest savings account.
So it's a waiting room for your money. Okay, moving up the risk ladder just a tiny step. Mortgage funds. Now, when I saw this in the notes, I panicked. Mortgage fund sounds like I'm investing in my neighbor's house. What if he loses his job and stops paying? Do I lose my money?
It's a valid fear, especially given what happened in 2008 in the U.S.
Right.
But in the context of standard Canadian mutual funds, these are generally quite conservative. They invest in pools of residential mortgages, yes, but the vast majority are National Housing Act insured.
Oh, NHA insured, so that means they guaranteed.
They are guaranteed by the Canada Mortgage and Housing Corporation, the CMHC, which is a federal agency.
Right.
So if the homeowner defaults, the government backs the loan. The the risk of you losing money because someone didn't pay their mortgage is extremely low.
Okay, so if the default risk is low, why isn't it risk-free? What catches people out with mortgage funds?
Interest rates. This is the aha moment for fixed income, and it confuses almost everyone the first time they hear it. Mortgage funds and bond funds have an inverse relationship with interest rates. If interest rates go up, the value of the fund goes down.
Okay, let's stop here. We need to unpack this because my brain rejects it. If interest rates go up, shouldn't my investment be worth more? Shouldn't I be cheering?
You would cheer for the new money you put in. But think about the money you already have invested. Let's use a simple analogy. Imagine you own a bond that pays you 3% interest every year. You bought it last year. It's a guaranteed 3%.
Okay, I have my 3% bond. I'm happy.
Now, the central bank raises interest rates. Suddenly, new bonds are being issued today that pay 5%.
Well, now I'm jealous. I want the 5% bond.
Exactly. And so does everyone else. Now, imagine you try to sell your old 3% bond to me. Why would I buy your bond that pays 3% when I can go to the market and buy a new one that pays 5%?
You wouldn't. Unless
What?
I made it a deal.
Bingo. You have to put your bond on sale, you have to lower the price, you have to sell it to me at a discount so that the math works out, and I effectively get a 5% return on my money.
Oh, so the value of my old bond drops so that it stays competitive with the new rates?
Precisely. So when interest rates rise, the market value of all those existing mortgages and bonds in the fund drops immediately. That is why you can see a bond fund lose money in a year where rates are rising fast.
That is the teeter-totter. Rates up, price down.
Yeah.
That makes perfect sense now. So let's look at bond funds specifically. They're the next step up. How are they classified?
Bond funds are usually grouped by two things: creditworthiness and maturity.
Okay.
On the credit side, you have investment grade. These are blue chip companies, governments, very safe versus high yield.
High yield is the polite term for junk bonds, right?
It is. These are riskier companies. Maybe they are struggling, or they are startups with a lot of debt. They have to pay a higher interest rate, a higher yield, to convince people to lend them money. If you buy a high yield bond fund, you are taking on more risk of default in exchange for those juicy interest payments.
And the second classification was maturity.
Right. Short term, which is under 5 years, intermediate, 5 to 10, and long term, 10 plus. And based on that teeter-totter rule we just discussed, which one do you think is riskier?
Well, if I'm locking my money away for 20 years with a long-term bond, a lot can happen with interest rates in 20 years.
Exactly. The longer the time until the bond matures, the more sensitive it is to interest rate changes.
Hmm.
Long-term bond funds will fluctuate in price much more than short-term ones. They are more volatile.
Okay, so we've got the safety net. We understand why bonds move. But most people don't want to just preserve their cash. They want it to grow. They also don't want to lose it all. They want a balance.
Which brings us nicely to Section 3, the Balancing Act.
Balanced funds. The Goldilocks of the investment world. Not too hot, not too cold.
It really is the default setting for many investors. A balanced fund is a single fund that holds a mix of equities for growth and bonds for safety and income.
The best of both worlds.
The mandate usually requires a fixed asset allocation. For example, the prospectus might say the fund must hold 60% equities and 40% bonds within a certain range.
So if the stock market crashes, the bonds cushion the blow. If the stock market rallies, you participate in the gain. It smooths out the ride.
Precisely. But there is a hidden superpower in balanced funds called rebalancing.
That sounds like a chore.
It's actually a discipline. Let's say you start with that 60% stock, 40% bond mix.
Okay.
Imagine the stock market goes on a tear. It booms. Suddenly, your stocks are worth way more, and now your portfolio is 70% stocks and 30% bonds. You have drifted.
Okay, so I'm richer. Why is that a problem?
Because you are now taking more risk than you signed up for. You are 70% exposed to the stock market. So the manager does something that is emotionally very hard for individuals to do. They sell the winners.
Yeah.
They sell some of those high-flying stocks and buy more boring bonds to get back to the 60-40 split.
They sell high and buy low. Automatically.
Exactly. It forces strategic asset allocation. That's the long-term plan, sticking to the mix.
Is there an alternative to sticking to the plan?
Yes, it's called tactical asset allocation. This is where the manager is allowed to deviate temporarily. Let's say the manager thinks the stock market is about to crash. A tactical manager might shift the mix to 50% stocks and 50% cash to time the market and protect the fund.
So strategic is the diet plan you stick to no matter what. Tactical is saying, it's Christmas, I'm going to eat the cake.
That's a fair analogy. Tactical is about seizing short-term opportunities or avoiding short-term threats.
Now, there is a specific type of balanced fund that has become huge lately. If you have a workplace pension, you're probably in one.
Yeah.
The target date fund or life cycle fund. This is the one where you just pick the year you want to retire, right?
Yes. These are brilliant for their simplicity. They solve the biggest problem in investing: human inertia. The concept is a glide path.
Glide path like an airplane coming in for a landing.
Exactly. Let's look at the example of Wilma from our source text. Wilma is 40 years old. She plans to retire in 25 years, around 2050. She buys a target date 2050 fund.
Okay, so right now she's 40. She has 25 years to grow her money. What's in the fund?
Right now, she can afford risk. She needs growth to beat inflation, so the fund is aggressive, mostly equities, maybe 80 or 90%.
Okay, now let's fast forward. It's 2045. Wilma is 60. She's 5 years away from retirement.
If she was managing her own money, she would need to remember to sell those risky stocks and buy bonds. If she forgets and the market crashes right before she retires, she's in trouble.
The nightmare scenario.
But the target date fund does it for her. Over those 20 years, the fund has automatically been selling stocks and buying bonds. By the time she's 60, the fund might be 60% bonds. It has become conservative. It has glided down to a safe landing.
So she doesn't have to wake up at 64, see a market crash, and realize she has to work at Walmart for another 10 years because she forgot to rebalance.
Exactly. It manages the changing risk profile of your life automatically. For the set it and forget it crowd, it is a very powerful tool.
All right, let's take off the training wheels. Let's talk about the growth engine. Equities, stocks. This is where the action is. This is where people make and lose fortunes.
This is where you move to the right side of that risk-return graph. You are accepting higher volatility, meaning the price bounces around a lot more, for the chance of higher long-term rewards.
And equity funds aren't just one big blob. They are sliced and diced in a million ways. One of the most common is by market cap. We hear about small cap and large cap. What are we actually talking about?
Market capitalization is just the total value of a company. It's the price of one share multiplied by the total number of shares. It tells you how big the company is.
So large cap.
Large cap refers to the big, established players, blue chip companies. usually valued over $5 billion, often hundreds of billions. Think the big banks, the major telecom companies, the tech giants like Microsoft or Apple.
These are the battleships. They aren't going to sink overnight.
Right. They are stable, they often pay dividends,
Yeah.
but they probably aren't going to double in value in 6 months. They are already huge.
And small cap.
Small cap is typically companies valued between, say, $100 million and $1.5 billion.
Yeah.
These are younger companies or niche players.
Give me a flavor of what a small cap company looks like.
It could be a regional trucking company or a biotech firm that has one promising drug in trials but no sales yet, or a small software startup.
So the risk is higher.
Much higher. A small biotech company can go to zero if the drug fails, but if the drug succeeds, the stock could go up 500%. Large caps offer stability. Small caps offer explosive growth potential. But you have to have the stomach for the volatility.
Got it. Now, this next one is the one I've been waiting for, the geography.
Mm-hmm.
I always assumed global and international meant the same thing, basically not Canada.
Mm-hmm.
But the source material says I'm wrong.
You are, and this is a really common confusion. Let's clarify. If you buy a global equity fund, the manager has a mandate to invest anywhere in the world. That includes Canada and the US. It is truly the whole globe.
Okay. And international.
In the context of North American investing, international equity usually means everything except North America. It invests outside the domestic market. It typically excludes the US and Canada.
That is a huge distinction. If I live in Canada and I buy an international fund thinking I'm diversified, I'm missing the United States.
Exactly. And think about what you are missing. You're missing Silicon Valley. You're missing the biggest economy in the world. If you pair a Canadian equity fund with an international equity fund, you have a massive hole in your portfolio shaped like the USA.
That is dangerous. So why would anyone buy international?
To explicitly add foreign exposure to a portfolio that already has North America covered, if you already own an S&P 500 fund, you don't need a global fund, which would just double up on the US. You need an international fund to catch Europe and Asia.
Fascinating. It's puzzle pieces. You have to know what shape you're buying.
Precisely. And speaking of specific shapes, specialty funds. This is the high-risk, high-reward aisle of the grocery store.
These are the funds that concentrate on a single sector or theme, like a technology fund or a precious metals fund.
Right. And the risk here is lack of diversification. If you buy a technology sector fund and the tech sector booms, you look like a genius. You beat the market.
Like in the late 90s.
And then 2000 hits, the dot-com bubble bursts, tech stocks fall 80%. If you are in a diversified fund, the other sectors might save you. If you are in a sector fund, you have zero cushion. You take the full force of the crash.
So these are for tactical bets, not for your life savings. What about real property funds? Not mortgage funds, but funds that actually own buildings.
Real property funds invest in physical assets, shopping malls, office towers, apartment buildings. The benefit is you are buying tangible assets that usually act differently than the stock market.
Right.
But there is a major limitation: liquidity.
Right. You can't sell a skyscraper on an app in 3 seconds.
Exactly. Because the underlying assets are hard to sell, these funds often aren't priced daily. Their value is based on appraisals, which might happen monthly or quarterly.
And what happens if everyone wants out at once?
That's the danger. If there is a run on the fund, the manager might have to freeze redemptions. They might say, sorry, you can't have your money yet. We need 6 months to sell this office building. You lose that instant access to cash.
That is a very important risk to understand. You can't treat it like a checking account.
One last one in this section. Labor-sponsored investment funds, or LSIFs. These used to be everywhere in Canada. They were. These are funds designed to invest in Canadian startups' venture capital. The government wanted to encourage innovation, so they offered a carrot.
A big tax break.
Huge. A 15% federal tax credit plus provincial credits. It was free money. But the source material explicitly notes that the federal tax credit was eliminated by 2017.
So the candy is gone.
The tax candy is largely gone, but the risk remains. You are investing in startups. The failure rate is high. Without the tax credit buffer, these have become much less attractive for the average investor.
Okay, so that covers the standard mutual fund world. But if you walk down the other aisle of the investment supermarket, there are all these other products: ETFs, hedge funds, principal protected notes. Let's break these down quickly, starting with the biggest disruptor in modern finance, the ETF.
To understand the ETF, the exchange-traded fund, we first have to understand the index fund.
An index fund is just a mutual fund that copies a list, right? It's not trying to be smart.
Yes, It's passive. The goal isn't to beat the market. It is to be the market. If the S&P TSX Composite Index goes up 5%, the fund should go up 5%. The manager doesn't pick stocks, they just buy whatever is on the list.
But the source mentions tracking error. Why doesn't it match perfectly? If the index is up 5.0%, why is my fund only up 4.8?
Two reasons. One is fees. Even low fees drag the return down slightly below the index. The index itself doesn't have an administration fee, but the fund does.
Right.
The second is sampling. Sometimes an index has thousands of tiny companies. It's too expensive to buy every single one, so the manager buys a representative sample. That creates a slight difference in performance.
Okay. Now, combine that index strategy with the stock market and you get the ETF. How is it different from a regular mutual fund?
It's all about how it trades. A standard mutual fund is priced once a day. You put your order in at 10 a.m., but you don't know the price until 4 p.m. It's slow. An ETF trades on the stock exchange like a stock. You can buy it at 10.03 a.m. and sell it at 10.1 a.m.
So maximum liquidity and usually lower fees.
Usually, yes. Because they are passive, the management expense ratios, the earns are lower. But let me ask you, do you need to be able to sell your retirement fund at 10:25 a.m.?
Probably not. In fact, knowing me, that might be dangerous. If I see the market dip, I might panic sell.
Exactly. The liquidity is a feature, but for long-term investors, it can be a behavioral trap. It makes it too easy to tinker.
Then there's the fund of funds, which sounds like a Russian nesting doll situation.
It is exactly that. It's a mutual fund that invests in other mutual funds.
Why would I do that?
Simplicity. You buy one fund, and inside it, the manager has picked a Canadian equity fund, a U.S. equity fund, a bond fund, and an international fund. They handle the rebalancing, they handle the selection. It's a total portfolio solution in one ticket.
What's the catch?
Fees. You might get hit with double fees. You pay a fee for the fund of funds manager, and you're also indirectly paying the fees of the underlying funds inside the portfolio. You have to watch the MER closely there.
Okay, what about PPNs? Principal protected notes. I see these advertised at banks.
Right.
Participate in the stock market with zero risk. That sounds like a scam.
It's not a scam, but it's not magic either. These are debt instruments issued by banks. The deal is, you lend the bank your money for, say, 5 years. They guarantee they will give you back your principal, your original investment at the end.
So I can't lose money.
Technically, the guarantee is on the principal, but instead of paying you guaranteed interest like a GIC or a CD, the return is linked to an index, like the S&P 500.
Okay.
If the market goes up, you get the gains. If the market crashes, you just get your original money back.
All upside, no downside. What's the catch?
The catch is opportunity cost. There is no fixed coupon rate. If the market is flat for 5 years, you get your money back, but you've earned zero interest. Meanwhile, inflation has eaten 10 or 15% of your purchasing power.
Oof.
You haven't lost dollars, but you've lost value. Also, you usually don't get the dividends from the stocks, just the price appreciation. You are paying for that safety with the potential returns you gave up.
Right. Nothing is free.
Okay, 2 more. Hedge funds and segregated funds.
Hedge funds are the velvet rope area. They are for accredited investors, wealthy individuals. They operate outside the normal strict rules of mutual funds. Their goal is absolute return,
Meaning?
meaning they want to make money even if the market is down. They use leverage, which is borrowed money. They short sell, which is betting against stocks, and they use complex derivatives.
So they are high risk.
They can be. Or they can be low risk, but high complexity. The main thing is high fees. You might have heard of 2% management fee plus 20% of the profits.
Ouch. And segregated funds.
Think of these as the insurance industry's version of mutual funds. They invest in stocks and bonds, but they come wrapped in an insurance contract.
Why pay for the wrapper?
Guarantees. They often guarantee that if you hold the fund for 10 years or until death, you will get at least 75% or even 100% of your money back, regardless of what the market did.
Plus, they can offer creditor protection. If you go bankrupt, creditors often can't seize your segregated funds because they are technically an insurance policy.
But I assume that insurance costs money.
Yes, the MRRs are typically higher than standard mutual funds to pay for those guarantees.
Okay, so we know the vehicles. We've covered the safety, the growth, the weird stuff. Now I want to talk about the driver, the architect. Section 6 refers to portfolio management theory. Who are these people making the decisions and how do they think?
The portfolio manager, we mentioned them earlier, these are the fiduciaries. But there is a massive philosophical divide in their world. the battle between passive and active management.
This is the religious war of finance.
It is, and it centers on one concept, the efficient market hypothesis, the EMH.
That sounds impressive. Break it down.
The theory states that markets are efficient. This means that at any given second, the price of a stock already reflects all available information. Every news article, every earnings report, every rumor, every tweet is instantly analyzed by millions of traders and algorithms, and the price adjusts immediately.
So if Apple releases a new phone, the stock price adjusts in a millisecond.
Exactly. So if the market is efficient, it means a stock is never too cheap or too expensive. It is always priced exactly right.
And if it's always priced right, then you can't find a bargain. You can't beat the market.
Correct. That is the passive argument. If you can't beat the market because the market knows everything, don't try. Don't pay high fees for a manager to guess. Just buy the index fund and ride the wave.
And active managers obviously disagree, or they wouldn't have jobs.
Yes. Active managers believe markets are inefficient. They believe that human emotion, panic, greed, or just lack of attention creates opportunities. They believe that if they do deeper research than the other guy, they can find a stock that is worth $50 but trading at $40.
They believe they can find a mistake in the price.
Exactly. Their goal is to generate alpha, to get a higher return than the benchmark index.
And to do that, they use different strategies. The source outlines top-down versus bottom-up. I love these terms because they sound like dance moves.
They are ways of viewing the world. Let's play this out. Imagine a manager named Donna. She runs the Bedrock International Growth Fund. Donna is a top-down thinker.
Okay, how does Donna start her day?
She starts with the macro. She looks at the globe. She might say, okay, the Eurozone is recovering faster than expected. German GDP is looking strong.
So she picks the country first, Germany.
Right. Then she looks inside Germany. What benefits from a recovering economy? Construction and manufacturing. I like the steel sector.
Country, then sector.
And finally, she looks for the best company in that sector. ArcelorMittal is the best steel company, so she buys it. Her logic flows from the big picture down to the stock.
Now contrast that with bottom up.
This is Jenny. She runs the European Value Fund. Jenny doesn't care about German GDP. She doesn't care if the Belgian economy is sluggish. She is looking at companies.
You're looking for a diamond in the rough.
She finds a small Belgian bank. She looks at their books. She sees they have great management, huge cash reserves, and for some reason, the stock is trading at a massive discount. She buys it.
Even if she thinks Belgium is in a recession.
Yes, because she believes this specific company is strong enough to succeed anyway. She picks the stock first, regardless of the macroeconomics.
So Donna looks at the forest, Jenny looks at the trees,
Perfect analogy.
and then we have the style of picking, growth versus value.
This is about what kind of tree you want. Growth managers are looking for the next Amazon. They want companies with expanding earnings, new technologies. They are willing to pay a premium, a high price for a stock because they think it will grow into it.
They are optimists.
Value managers are bargain hunters. They are looking for stocks that are on sale. Maybe the company had some bad PR or the sector is uncool. They calculate the intrinsic value, what the company is really worth. And if the stock price is lower than that, they buy. They are waiting for the market to realize its mistake.
Section 7 gets into the nitty-gritty of the analysis. How do they actually decide what the intrinsic value is? There are two schools of thought here too, technical versus fundamental.
Fundamental analysis is what we just described, looking at the books. Revenues, assets, profit margins, debt levels. It's analyzing the business itself. It's accounting.
In technical.
Technical analysis is totally different. These are the chartists. They don't care if the company sells cycleware or socks. They look at the stock price and volume charts.
They look for shapes.
Literally. They look for patterns in the squiggly lines, head and shoulders, double bottoms, resistance levels. They believe that history repeats itself and that the price movement tells you everything you need to know about supply and demand.
That always feels like reading tea leaves or astrology to me.
Yeah.
Mercury is in retrograde, so sell Apple.
It has its critics, but it is widely used, especially for timing, deciding exactly when to buy or sell.
Finally, we have to talk about the math that holds it all together. Modern portfolio theory. MPT. This is the Nobel Prize stuff.
It is. Before MPT, people thought risk was just about the individual stock. If you bought a risky stock, you had a risky portfolio.
Makes sense.
But MP2 showed that if you combine dissimilar assets, like stocks and bonds, you can actually reduce the overall risk of the portfolio without necessarily sacrificing return.
Because of correlation.
Exactly. When stocks zig, bonds often zag. If you hold both, your ride is smoother.
And this leads to the concept of the efficient frontier. This sounds like a sci-fi movie.
It's a beautiful concept. Imagine a graph. The vertical axis is return, how much money you make. The horizontal axis is risk, how much the price bounces around.
Okay, visualizing.
You plot every possible combination of assets. 100% stocks, 50-50, 100% bonds. You get a cloud of dots. But the very top edge of that cloud forms a curve. That curve is the efficient frontier.
What does it mean to be on the curve?
It means that for that specific level of risk, you are getting the maximum possible return. You cannot do better mathematically.
If I'm below the curve.
You are inefficient. You are taking too much risk for too little return, or you could be getting the same return with less risk. The goal of every portfolio manager is to get you onto that efficient frontier.
So we have gone from defining a unit all the way to the mathematical frontier of efficiency. We've covered a massive amount of ground.
We have, and I think if there is one synthesis to take away, it's this. In the world of mutual funds, risk isn't a bad word. It isn't something to be avoided at all costs.
It's the price of admission.
It is the currency you pay for potential return. The basket, the mutual fund, is just a tool to help you spend that currency efficiently, to make sure you aren't overpaying for risk.
Whether you are buying a set-it-and-forget-it index ETF or paying higher fees for an active manager like Jenny to find those hidden gems.
Exactly. It's about knowing what you are buying. When you understand the difference between a bond fund's interest rate risk and a sector fund's concentration risk, you can make choices that match your life. You can sleep at night.
That is the goal. But here's a thought to leave you with, and it's one that keeps me up at night.
Oh.
We talked about the efficient market hypothesis, that all info is priced in. If that is true, if the market is truly perfectly efficient, why do active managers still exist? And more importantly, why do some of them consistently win? Is it just luck? Is Warren Buffett just the guy who flipped heads 50 times in a row? Or is the market not as efficient as the textbooks claim?
That is the multi-trillion-dollar question. If the market were truly efficient, no one would trade, and price discovery would stop. It's a paradox. And as long as humans are involved with our fear and our greed, I suspect there will always be inefficiencies to exploit.
Something to mull over before you check your portfolio balance. Thanks for decoding the basket with us today.
My pleasure.
We'll see you on the next Deep Dive.